Good day and welcome to the Spring Statement event with Lex Autolease conference call. Today's call is being recorded. To join today's presentation, please check your invitation email for login details. At this time, I would like to turn the call over to Craig McNaughton. Please go ahead, sir.
Thank you, Kevin, and good afternoon, everyone. Welcome to the Lex Autolease Spring Statement overview. My name is Craig McNaughton, Corporate Director for Lex Autolease, and delighted to welcome so many of our customers onto the call today. I'm joined by a number of my colleagues from all different parts of the country. So we've got Andy Barrell, who's joining us from Somerset. We've got Miriam Brathington from Cardiff, and then we've got a whole bunch of individuals from into our Cheadle office, and then delighted to have also got Tom McLennan from BVRLA. So we're just kind of never quite sure how much there would be in Rishi Sunak's statement yesterday. So we'd already planned to look at some of the other areas of disruption in the marketplace, and boy, we had some disruption recently. We certainly yesterday probably didn't expect to see, although we might have hoped that we might see some insight, benefit in kind beyond 2025 or on future road charging. We didn't see any of that, but actually we'll certainly talk about some of the impacts likes of the national insurance adjustments. I'm delighted also we're joined by Tom McLennan from BVRLA, so Tom will be able to give us a real insight of market conditions from our preeminent leasing body, and he'll talk about some of the burning issues that the BVRLA have been leading into. We're also going to take a look at our whole electric vehicle transition, how we're supporting that as a business, and just with particular eye towards the impact that salary sacrifice is having on supporting that transition, but also in supporting staff retention at a time when I think all industries are seeing high vacancies and difficulty in attracting and keeping colleagues in our various businesses. We're then going to take a deeper look into what supply chain disruption is happening across pretty well every service that we offer. And more importantly, what are we doing about it as a business? And equally importantly, what we see as best practice for our customers in order to mitigate some of the challenges being faced. But before I hand you over to Ashley, I wanted probably just to walk through just some of the other impacts of supply chain disruption and the impact that that's had on us as a business at Lex Autolease. Like most businesses, we do our planning and for our resourcing up to kind of 12, even 18 months in advance, set our budgets accordingly. We go through a rigorous governance channels. We set ourselves a business plan, and we look at the market opportunity and how we will kind of service that. It's probably fair to say that through 2021 and probably the second half of 2021 in particular, that planning was really blown apart by the vehicle supply chain disruption. We saw the impact of constantly changing prices, uncertain and ever-changing availability on vehicles, and just a general lack of transparency from OEMs, and that's kind of left us spinning plates like never before. We've been hit by a literal tsunami of requotes, where almost 90% of our vehicles are going to be requoted between 6 and 8 times. And as we go through that requote process, we're finding that a third are then unavailable to quote when we want to, and the process gets further delayed. As a result of that, we've got an almost constant rotating backlog of over 2,000 requotes, which has meant that keeping customers updated, maintaining service has been a huge challenge, which has been saved really only by incredible commitment from our teams. But you know, like many, when supply chain challenges kicked off, we kind of hoped it would be short term, but it certainly became apparent as we went into Q4 of last year that we've got a problem that will be with us for at least another 12 months. So as a result, you know, what we've done recently is we've ripped up these resource plans, went cap in hand up the line to our parent company to get more FTE, signed off to support with that challenge. I'm delighted that we did manage to get 29 additional colleagues signed off in the last few weeks. So we're actively recruiting and training these as permanent employees at the top. That's a major achievement to get that, as anyone who fights against the budgetary processes in large corporates will attest. But if you're one of these customers that's felt the pinch as we work through these challenges, then thank you for bearing with us. The fresh cavalry is coming over the hill, and with the current training that's going on and the embedding of new colleagues, we would expect all the requote volumes to be under control and our full service level adherence by mid to late summer. You're going to hear a lot about some of the wider supply chain challenges, particularly around parts, labour, ramp time, car and van rental, where we're taking supplier actions. But in this instance, the resource was in our control. We're faced into that. We'll see the resolution very shortly, and as I say, thanks for the support as we've worked through that supply chain disruption. And we will get through that, but we do have an incredible positive momentum to get excited about. Electric vehicles if we could get hold of them, are following an incredible upward trajectory, and that's encouraging multiple drivers back into car schemes and salary sacrifice schemes. And we've got an unusual prime position as a real leader of the sustainability agenda among all our corporates to help climate change agenda through that electrification of our fleet. We're also seeing commercial vehicle market continuing to grow, and that, you can only see that continuing as businesses gear up for more home deliveries and the likes. And from our own perspective, we've got some really positive initiatives coming live in the next couple of months. We've got further digitisation of our customer journeys, such as ordering, collections, early terminations. We've got a new digital salary sacrifice proposition that is very much live and kicking in many of our customers already. We've got new downtime management telematics-driven proposition pilot going live to 5,000 commercial vehicles on the 24th of May. Commercial vehicle online build management process going live next month, and a load of others that are still in the kind of sign-off process. So we've got looking at things like bundled chargers, secondary leasing, further digital journeys, all in our corporate lab and governance process at the moment to kind of work our way through. So lots and lots to be excited about. We'll talk a lot about what's going on in the industry, I've said, but if you've got any questions as we go through the process today, please place them into the chat, and we'll pick them up at the end of the session and try to answer them as we go through. So we're going to move on to the agenda now, and I'm delighted to introduce our head of consultancy, Ashley Barnett, who's going to talk about the outputs of the Spring Statement yesterday. Not easy for me to say. Over to you, Ashley.
Thanks very much, Craig, and good afternoon, everyone. And firstly, if I can apologise for those of you who are expecting Eduardo Thomas from my team. Unfortunately, Eddie's one of the number of people at the moment who seem to be being struck by COVID, stroke flu, stroke cold. So you're going to have to make do with me, I'm afraid, today. So as Craig mentioned, there were a number of things that we were hoping for, I suppose, within the Spring Statement, and we've kind of called out the main ones on here. Obviously, the kind of lead that Rishi Sunak mentioned yesterday was the 5 pence per litre fuel duty cut, kicked in at 6 o'clock last night. So for those people, driving petrol and diesel or plug-in vehicles and using that the primary fuel source, that should have come alive at 6 o'clock last night. The employee national insurance contribution primary threshold, so that will change in July. So an increase of around about £3,000. So for those earning below £34,000 a year, they should see an increase in their net pay from July onwards. And the reason for that delay in introduction is to give employers the opportunity to get payroll systems up to date. It's nice to see that there's been recognition that you can't just make these changes overnight. The third change was kind of confirmation of something that had already been announced last year, that the 1.25% healthcare levy is going ahead on the 6th of April. Obviously, there's been a lot of noise in the media around whether this should be something that was delayed or deferred, and obviously the opposition parties yesterday did question whether with everything that's going on at the moment that should continue to take place. It is, and obviously we'll see an increase to both employee national insurance contributions and employer national insurance contributions from the start of the 6th of April tax year. The fourth one was a very unusual kind of commitment from the Chancellor, and that was to make a basic tax cut to the basic rate of tax from 20% to 19%, which they've committed to by the end of this government, so from the 6th of April 2024. Albeit in the small print, it did obviously make reference to the fact that there's some quite strict spending conditions and inflationary conditions that need to be met before that will take place. Obviously, that 20% is the UK tax rate, excluding Scotland. And then numbers 5 and 6 are the two things that, I don't know, Tom McClellan from BVRLA will touch on number 5 especially. You know, we were hoping to see some reference to benefit in kind tax tables beyond the 5th of April 2025 being announced, and unfortunately didn't, and we're going to kind of touch on shortly what that might mean from a policy point of view. And lastly, we didn't see a change to the private fuel benefit above and beyond what was announced towards the back end of last year. So obviously, Craig's made reference already to the huge amount of change we're seeing in the market, and you know, from a company car policy perspective, we're going to touch on a couple of things here. We've obviously seen changes to the advisory fuel rates. We've seen changes to the advisory electric rates. We're seeing changing to the benefit in kind tables, and we've also seen the 1.25% employer NI increase changes as well. So over the next couple of slides, just wanted to bring this to life in terms of what does that mean from a policy perspective. The top left-hand graph, you can see that even with those increases over the last 16 to 18 months, we're still seeing that the increase in the electric kind of fuel cost, if you will, within whole life cost is still a lot lower than petrol or diesel engines, regardless of the engine size. And in the bottom right-hand corner, we look at, you know, a range of taxable list prices and the impact of the employer NI change and the benefit in kind tables. So you can see there that even a £50,000 electric vehicle is seeing a smaller cost increase in terms of national insurance than a £30,000, you know, 100 gram per kilometre petrol or diesel vehicle. So although there are changes that are having an impact from a whole life cost perspective, we're seeing that the impact from an electric vehicle perspective is still lower than it would be for any other vehicle. And just to put that into context, the next slide, we've put 4 vehicle examples ranging from electric through to plug-in hybrid, a diesel and a petrol. We've picked Volkswagen as having an option in each of those categories. And you can see there, you know, each of the component parts, and we've compared April 21 through to April 22. And what you can see is that the whole life cost increase on the electric vehicle is just short of £15 a month, whereas even for the plug-in hybrid, that's closer to £40 a month. So from a policy perspective, you know, the transition to electric that many of you probably have already made, and for others you may be joining that journey, even though the costs are increasing, they're still, you know, preferential compared to their alternative vehicle counterpart. We've already spoke about there's a lot of things now going on. We spoke about there's no benefit in kind beyond 2025. So this slide just aims to call out some of the things that, you know, from my perspective, me and my team would recommend that, you know, customers are looking at, you know, with that uncertainty regarding benefit in kind for those on 4-year contracts. People may be considering what options they've got. That may be a potential to revise 3-year contracts in the short terms, but to be honest, the higher leasing cost, from my view, will, you know, probably exceed the national insurance increase that you'll see on any benefit in kind change that will go in beyond 25 and 26. So it's probably not necessarily worth it. I do think there's a huge opportunity for people to focus around cash allowances. It's often overlooked because it's not an obvious cost within most fleets. It's often something that's looked after by HR or payroll. And especially with sustainability priorities, there's probably been a focus on vehicles we'd use this as a recommendation to kind of look through the cash takers and see what people are doing. Not only looking at the cost of those vehicles, but also looking at the age and the fuel types that you've got on the fleet, so you can ensure you're progressing not only your car fleets, but also you're progressing grey fleet as well. And then finally, for me, before I hand over to Thomas from the BVRLA, is, with that short-term uncertainty, it may be something that you contemplate is looking at contract amends. So there may be the opportunity to get you through to kind of the autumn statement, because again, we would expect, and again, Thomas hopefully will cover that, in the autumn statement, that the Chancellor does publish the benefit in kind rates beyond April 2025. So just quite some high-level information there in terms of, our view on what you could be looking at in the short term. So Thomas, if I can hand over to you for a view from the BVRLA, please.
Sure thing. Thank you so much, Ashley. Hi, everyone. I'm Thomas Chen, Head of Policy and Public Affairs at the BVRLA. If we jump to the next slide, please. It was not the most exciting spring statement, as Ashley has alluded to. I think there were a lot of people who wanted to see a lot more, and I'm not best placed to speak to those concerns around cost of living challenges and those areas, which I think we see a lot in the press today around the challenges there and the need to see those addressed. But from a very specific to the vehicle side, we had a number of asks which we went into the spring statement with, and they set out on the slide. Specifically, first and foremost, more certainty around BIC rates, a drop in the leasing and rental exclusion from the Capital Allowances Act, launching road pricing consultation process so we could know what the tax structure of the future might look like. We have massive concerns around the discrepancy in VAT rates for charging at home versus charging on the public network, where at home charging through domestic network, it's a 5% VAT rate, where if you use public charging, it's a 20% VAT rate, and that doesn't seem like something to create a just transition towards electric vehicles. And finally, we always in support of a modal shift methods to encourage people to have as many routes to transport as they need. Now, to break away from the slightly negative note, we did get one major win in the spring statement, and that was a confirmation from the Chancellor that HMT will be reviewing capital allowances. And this is a slightly niche topic. Not everyone is super excited about capital allowances. I am one of those people. It is an incredibly powerful measure. The UK consistently ranks below comparison nations with business investment levels. And what we need to see in the UK is a structure that is simplified, is more straightforward, and enables firms to unlock the investment that we need to foster growth. And the Chancellor has recognized this. This is something which the BVRLA has been campaigning for almost 5 years now. So we are very, very happy to see that the Chancellor is grappling with this. And most interestingly to us is that they haven't set forward a set idea. They haven't, often with government, when they say they're going to review something, they review it with already an answer in mind. They say, we're reviewing something to produce that, and can you give us some opinions to support it? In this case, it seems an incredibly open door. There's a lot of interesting economic theory about what the best capital allowance structure could be, and the Treasury seems genuinely interested in engaging with business to try and understand what it is that works best. From our perspective, the strongest challenge we have to the capital allowance regime is it currently excludes all assets used for lease and rent. So all rental and leasing assets are completely excluded from the structure. There is no incentive for firms to invest in that space or support for their customers which flow from that. We think that is fundamentally unfair. So we're going to be launching a campaign in the near and sort of pretty much immediately. Hopefully we're going to get it off the ground by Friday to try and pressure the Chancellor. That should be one of the core reforms, that rented and leased assets should be included in the future of any capital allowance regime. So that's my very exciting takeaway from the spring statement. We really welcome that change, and we think it's a good piece of thinking, and It doesn't come out of the blue. As I say, over 5 years of work to try and shift Treasury mindsets around that, and we'll see where that goes. To the more frustrating news, and that's around BIC and a lack of foresight. And this is something we talk to Treasury about regularly. We know the pain it causes, the uncertainty, the challenges, and we've managed to get Treasury to, by challenging ministers in the House, we've heard the official statement is that Treasury wants to give a 2-year foresight, and that, you know, we need to push them to go further than that. And we are doing exactly that. We are hopeful that in the autumn budget we will get them to move beyond what they think is necessary. Again, it is turning an oil tanker around, or perhaps that's the inappropriate analogy for this, but it is a slow shift to change mindsets around this specific need for special certainty and special circumstances. The transition to net zero is a special circumstance. It is not an ordinary day of business to try and decarbonize fleets or decarbonize businesses, and we need a special level of certainty. We think that message is starting to get through, but we are nowhere near the finish line. And that is where we'll be coming to a bit later about what we're doing about that, but we are going to do all we can to try and make sure that we get some certainty from government in autumn. And we found it also very disappointing that the Chancellor acted on fuel prices but didn't act around electricity prices. I think Ashley put out very nicely how electricity costs still mean that the whole life cost of electric vehicles has increased less comparatively than petrol and diesel. But that doesn't mean that cost can be ignored. And we think it was a lost opportunity to look at that rebalancing of VAT, to look at other measures to support electric vehicle drivers to make sure that they don't get put off when the transition is only just beginning. And I think that's something which we try to make as clear as possible to Treasury whenever we engage with them. So this is just the start of a journey, and it is not the time now to try and pull back from support or special treatment, because we are only just beginning. If you jump to the next slide, please. So what are we doing about all this and the sort of lack of certainty that we heard? So first and foremost, we have a big campaign brewing, and this is somewhere where everyone in the industry can be looked at helping us on this. And we'll be getting it out there. We previously campaigned before the last autumn budget with the likes of the AFP and Fleet News, and we'll be trying to do the same this year, getting the message as wide and clear in front of as many policymakers as possible. As soon as we have that campaign ready to go, you will hear about it. And we would really look to everyone to support that who has any interest in this space. The second thing is what we want to do is build off whatever the government comes back to the Transport Select Committee on road pricing. You may or may not have been aware that the Transport Select Committee did an inquiry into road pricing where they came with a number of strong recommendations to government, including that they should set up a body to look at the issue by the end of this year. The government had 8 weeks to respond to that, and their 8 weeks is running awfully low. So we're looking forward to that response, and we will be trying to use that to leverage some action from government to make sure that we can have more certainty. The market doesn't need speculation in areas which are unnecessary. We know the government wants to have a future beyond fuel duty. Let's start talking about it, and we're going to try and keep the pressure up there as much as possible. The continued need for VAT equalization doesn't go away. There are many others campaigning on this issue, people such as Fair Charge, the AA, and others, and we think that this is going to persist until there is some sort of action. It doesn't seem right that people who are least able to make the transition to electric vehicles, those who don't have off-street parking, are then doubly penalized by not just having to access more expensive public charging networks, but also then have to pay higher VAT on that. That just doesn't seem like a just proposition, and we think there will be overarching momentum against us. How long that takes to build is another question. The government is traditionally very slow to move on VAT. The last big move we saw on VAT was due to the pandemic for hospitality, and that took very exceptional circumstances. Whenever I talk to the VAT teams at Treasury, the comment is, the lines around the block for us to look at VAT, you're going to have to give us something special. So I think this is one of those issues which might have the momentum there, but it'll be a long haul. The capital allowance reform, as I said, a very exciting space and one which we hope to have some good engagement with HMT on, and we should see that crystallizing in the autumn budget. That's what we've been promised, and we look forward to the event. I think the one thing I would also just like to emphasize for all firms is we're in a time of regulatory flux. We're not in a stable environment. We will have seen that with the supply chain challenges, which were flagged at the beginning. We have moved from a sort of era of stability to one of instability. We don't know what's around the next corner. And both from an environmental factor, but also from a regulatory space, there is continual change. There is great ambition in government post-Brexit to create a different regulatory environment to what we had before. And I think it's extremely important that firms keep themselves abreast of that through things such as this event. I think it's absolutely vital that you try and keep on top of what pressures are coming down your way and engage where you can. Engage with firms like Lex, engage with organizations like the BVRLA. So that's my plea at the end of that, and happy to hand back. Thanks so much.
Thanks very much for that, Thomas. A really interesting update as usual, and great to see all the work that's going on behind the scenes. I know there's a lot of effort. It's pedaling furiously below the water. And Miriam, we're going to hand over to you now for an update around the world of sustainability, if you could, please.
Thank you, Ashley. Hi, everyone. I'm Miriam Brassington, and I'm the Senior Manager for Lloyds Banking Group Motor Sustainability. I lead on our plans to reduce the emissions from the vehicles that we finance and lease through Black Horse and through Lex Autolease. Tackling climate change is fully aligned to our purpose at Lloyds Banking Group. You can see on the slide there that our purpose is to help Britain prosper and to support the transition to a low-carbon economy. Climate change is one of the most urgent issues facing society today. Lloyds Banking Group has a really important role to play in supporting that transition. Earlier this year, you can see on the slide that we launched our first standalone climate report. The report outlines 3 immediate actions. Firstly, the publication of new emission reduction ambitions for the bank's highest emitting sectors, and this included Lloyds Banking Group Motor, so for Lex and Black Horse, the ambition to reduce the emissions intensity of the cars and vans we finance and lease by more than 50% by 2030. Secondly, we will continue to invest in our skills and our governance, supporting climate risk management within the business. And lastly, playing a role in supporting public policy developments in the UK, such as Tom has talked about there, working with industry bodies to ensure that we can help represent clients' views and shape public policy in the UK. To support the decarbonisation of the economy, we've prioritised our own activities in the bank around net zero ambitions. In 2021, we announced a new set of operational climate pledges, including a commitment to achieve net zero carbon operations across Scope 1 and 2 by 2030, and at the same time halving our energy consumption and maintaining our travel-related carbon to below 50% of pre-COVID levels. And closer to home within motor, through the subsidiaries of Lex Autolease and Black Horse, we have one of the largest emission fleets now, low emission fleets in the UK, with around 1 in 10 pure battery EV cars on the road today are either financed via Black Horse or leased through Lex Autolease. In 2021, we almost doubled the number of electric vehicles we've financed and leased, and we've helped many corporate clients, including many on the call today, to sort of start and to continue their journey to transition the fleets to electric. Our commitment to the transition to electric is significant. We've demonstrated that in the recent EV100 publication, where across all leasing company members, Lex Autolease added the most leased EVs in any one country last year. which was just published, that's hot off the press yesterday. In support of our strategy and our focus on low-emission vehicles, we've announced an $8 billion of financing for pure EV and hybrids now between 22 and 24. And our plans include the development of some new digital solutions that Craig mentioned around charging and continuing to invest in salary sacrifice, as well as enabling access to some essential services for drivers that they need to run an EV, so that's underway. I think our role in both the vehicle leasing market as well as the new and used car finance market means we are really quite uniquely placed within Lloyds and Lex and Black Horse to support the entire life cycle of an EV from the sort of first use through to the second and third use. And we work really closely with all industry bodies, including the BVRLA and the FLA and a number of coalitions, as well as engaging direct with government now to advocate for policies to ensure long-term incentives are in place and that the charging infrastructure is appropriate, and that one of our key policies is around developing a really strong used electric vehicle market, which is really key to ensuring that electric vehicles are affordable and accessible to everyone. So in summary, I think, as a leading provider of green fleets, decarbonising road vehicles is absolutely key to our strategy and to supporting the UK economy. Through our consultancy team and trained CRNs, I think continuing to work with customers using the existing products and tools and some of the new things that we're delivering later this year, I think we feel confident we can help guide businesses through the transition. So I'll hand over to, I think I'm handing it over to Andy on site to go through our salary sacrifice developments.
Yeah, thanks, Miriam, and good afternoon, everybody. My name's Andy Barrell. One of the roles I fulfil in our corporate business is to develop the salary sacrifice proposition and promote what a fantastic benefit it is to employees. And just as what we want to cover today is really, because it was a bit of a low-key budget, the good news in that is that the fantastic benefits that are derived from salary sacrifice haven't changed, because this is part of the government's promotional strategy to get more EVs onto the road, make it affordable for as many people as possible. And one of the ways to do that is obviously through the provision of a salary sacrifice mechanism. So what we're going to cover off in the next 5 or 10 minutes is basically how it works, just to give everybody an overview because everybody's at different levels of understanding. Look at some comparable costs. What does salary sacrifice look like to other means of funding? And I think there'll be some surprises in that, hopefully. What's the market view? So what does it look like? What do people actually choose? What do they, how much do they want to spend? What is that sort of marketplace looking like? And what's the future state? What are the next developments going to be for salary sacrifice? So fundamentally, how does it work? So this little graphic at the top of the slide looks at the cost of the vehicle before you deduct your gross tax position. So you get the vehicle, the cost of that, you take off the tax you would have paid on it, and that gives you a position that you then have to pay benefit in kind tax, which is a minimal amount, if I'm honest, if you choose a full EV, because the tax rate for those vehicles is 2% for this next 2 tax years. So the net position is exceptionally attractive when you take off that post-tax calculation. So if we just flick on one graphic, what this gives us is a cost breakdown. So you've got an Audi e-tron here, and you start off with the gross salary sacrificed. You look at the tax you would have saved and do save. You add back the benefit in kind tax, which obviously is far less than the tax you would have paid. You end up with a net position of, for this vehicle, £449 a month. Now that is a 3-year lease. It is fully maintained. It's got roadside recovery within it, and it's an insured product. So this is based on the parameters you see at the bottom there. 3 years, 10,000 miles, fully insured, fully maintained. All you have to do is charge it up, or if you go for a hybrid, put a bit of fuel in it, and that is your cost capped. So a fantastic offer, especially when you think about how it compares to what you get in the market for a personal lease. So what I did yesterday, had a look, went to one of the largest leasing brokers in the UK and said, right, if we were going to have this vehicle, the very same vehicle on a personal lease, how much would that cost me? Based on 3 years of a lease and 10,000 miles, there's your price, £899. So you're looking at a salary sacrifice option, which is fundamentally half that cost. And it gets better because the actual personal lease cost doesn't include insurance and it is non-maintained. So there are additional costs over and above your £899. You can start to see how the salary sacrifice offer becomes exceptionally attractive when compared to the rest of the market. Now, what you've also got to bear in mind is, and quite perversely, the increases in national insurance that are coming into effect on the 6th of April, actually, because they make this product even cheaper for the employee and the employer, because the sacrifice of salary is greater in terms of the national insurance you are saving, because the cost is actually going up. And we shouldn't overlook, this isn't just this is a win-win situation for colleagues, but also the employer. Because you're sacrificing your salary, the employer doesn't have to pay national insurance on the salary you've sacrificed. So on this particular vehicle, per annum, the employer saves £1,220. So it's a fantastic win and a savings mechanism for the employer. It's a fantastic benefit for the employee. And also, it's for all employees. So it doesn't matter whether you've got a company car or not, you can have another one. But it will depend on where you are in the sort of change cycle of your personal transport, your personal mobility at the moment. Now, also, and this is where there's another benefit as well, which is often overlooked, is this is a no deposit position for the employee. So you only start to have the deduction from your salary when the vehicle has arrived and it's on the road. Most other funding mechanisms, you have to put a deposit down, and that can be anything from 1 month's rental in advance up to 12 months rental in advance. And also there's a credit check involved because it's a personal loan in effect. Whereas because this is through the employer, none of that happens. So it's almost the gift that keeps on giving, and you can perhaps now start to understand why this is becoming such an attractive offer for companies to provide to their employees. Massive recruitment and retention opportunities within it, because fundamentally it only stays with the colleague as long as they stay with your company. And also, if your business offers this scheme as opposed to someone else's business that doesn't, your retention and recruitment should be far higher. So great number of benefits from it. And this isn't a pitch, but this is just simply to outline the massive benefits that are available right now. Now, Rishi could have come out yesterday and said, oh, we're changing some of this benefit. The only thing he didn't do, which perhaps would have helped, was look at the benefit in kind beyond 2025. So what does that future state look like? Well, what you can do with the proposition is you don't have to take a car for 3 years. You can take one for 2 years. You can take one for 4 years. You can tailor it to your circumstance, so you can kind of risk mitigate any changes to the benefit in kind. But what we do know, the benefit in kind tax is probably only going to go one way in the future, but it's going to be marginal in terms of those steps and increments beyond 2025. So a great offer. And what does the market look like? So we've had schemes running for many, many years. But what we've done is taken a cut of our order book over the last 12 months just to see what people are actually ordering. And it's really interesting. So this is your top 20 vehicles of choice. Top 3, probably brands and models you would expect. Tesla Model 3, Audi Q4 and Volkswagen ID3. Now, they lead the pack by a long way in terms of percentage terms. And you're probably thinking, well, how come you haven't used a calculated example based on those then if they're so popular? Well, what we also track is what vehicles are rising through the sort of hit parade the fastest, and that is actually the Audi e-tron. That's one of the fastest upcoming vehicles that people are thinking, yeah, that's something I would like. So it's relevant that we give that some airtime. But also, what is the sort of term and mileage and what does it look like? So one more click gives us the market perspective. So of all our schemes that are live at the moment, 85% of colleagues are choosing a full EV. And you'd have probably thought, well, more people would have chosen hybrid, but absolutely not. The drive is definitely towards full EV. But also, if you're looking at the mileage, so average mileage, just over £10,000, average term, 3 years. That's what it's looking like. Now, also, down the bottom circle, £52,000, almost £53,000 is the actual capital cost of the vehicles they are choosing. That's a lot of car, yeah, and that's a lot of money to spend on a car, any asset. That's is significant. And our objective in the future state is to reduce that. Now, what we want to do is work with manufacturers, OEMs, our suppliers, to drive down that capital cost into the smaller end of vehicle capital cost, the sub £31,000 vehicle market, because fundamentally what we want to do is make this access method to sustainable mobility more affordable. And £52,000 cars still is a chunk of money out of your salary. So what we want to do is bring that price point down as far as we can. It's going to take more negotiations, it's going to take more development, but really that's what we want to do, make this accessible to far more people, more sustainable mobility, and that gets everybody further down the road onto that cost-saving piece and the green agenda. That's all from me. Thank you for listening. I think I'm handing over to Jeanette, but more than happy to take any questions on the chat or after the event. Thank you.
Thank you, Andy. Hi, good afternoon. My name is Jeanette Richardson. I'm the Senior Manager within Purchasing and Supply Chain Management within Lex. I'm just going to take you through quite high level, because there's a lot of information to share in terms of what's happening in our world and ultimately some of the market conditions. So you'll be very familiar with some of the semiconductor shortages, chip shortages, which is impacting actual vehicle supply. More recent one is with Tesla Model 3, chip shortages, which is impacting the actual ability to produce windscreens for those vehicles. Within Ukraine, that's having a negative impact, unfortunately, in the supply chain as well. More recently, and it's been in the press with regards to wiring looms, which is obviously impacting actual supply of the actual vehicles. What I would say is the manufacturers are proactively trying to source alternative suppliers to make sure that they actually minimise the impact of actual vehicle production. What we're also finding is the manufacturer's factory capacity is being severely impacted, which is actually meaning that we've got almost on a daily basis now manufacturers contacting us, basically saying that vehicles are at full to capacity and they are basically closing their order banks for any new vehicle orders. More recent one this week was with Ford, commercials, and basically aside from the e-transit, there is no battery production from the 1st of April until further notice. What we're also finding is that some OEMs, we've had a German manufacturer in the last week that's basically sent us through a list of 45 vehicles that have been on factory order for a number of months that basically they're saying they're cancelling. There's no alternative vehicles being produced, and unfortunately that's a negative message that we're going to have to obviously disseminate out to our end user customers. Vehicle lead times, as we all know, based on our growing order bank, in a lot of instances now we're looking at vehicle lead times going into Q2 and Q3 of 2023, which is unheard of in the industry. Vehicle price increases, again, it's almost a daily occurrence that we're in receipt of messages from our OEMs basically informing us of price increases. This is due to raw materials, which again in turn gets passed on to us as a leasing company, and then in turn to the end user customer. What we're also finding in terms of specification changes, so customer is ordering a vehicle with a particular specification, but what we're finding is again that those specifications due to component shortages are being impacted. So we are doing our best to endeavour to pass those changes onto the end user in terms of expectations of when a new vehicle is going to be delivered, that the specification ordered is not necessarily going to be the specification that's actually delivered. What we're also finding is within our supply chain, there's been a shrinkage over the last couple of years. We've got a couple of the larger dealer groups that basically are moving out of fleet and only concentrating on retail, which is then having an impact, obviously, on the number of vehicle allocations that we're actually able to source. Labour rates, oil prices and raw material costs are obviously on the increase. Several of the presenters have already noted actual increases that are actually happening, which is obviously having a knock-on effect in terms of the overall vehicle price. Resourcing within the network is also been an absolute challenge over the last couple of years. In 2021, we've seen an increase of 200% of vacancies across the industry, which is absolutely astronomical. And what we're finding is, people are moving, lifestyle changes or otherwise, but they're also being, shall we say, tempted by, I'm not saying I'd like to be an Amazon delivery driver, but we're finding, people are actually moving out and going to alternative routes for employment. Reduction in supply terms, again, so we've got the negative impact of vehicle price increases, but then we've also got the impact of suppliers, manufacturers that is, actually reducing their supply terms, one to other standard terms, but two to end user customers. So some of the proactive measures that we're trying to do, so all of that information in the first column and all the information, communications that we're receiving, we're actually disseminating that information and sharing it with our sales and customer services colleagues effectively upon receipt. As you can imagine, our inboxes, Yammer pages, internal websites are bulging, to say the least. We're actually working with additional third-party providers and have been doing for quite some time to try and support the servicing booking direction. So things like while you wait and express vehicle servicing, so rather than waiting 2 to 3 weeks to book a vehicle in for a service, there's an alternative out there, while you wait, or as I say, express vehicle servicing, or indeed our third-party provider. So we're working with a company called Fleet Assist, who effectively onboard additional suppliers to support the actual after-sales servicing work. Vehicle ring fencing. So what we've actually been doing is working with some corporates, just as a bit of a test and learn, to try and work again with the OEM to try and ring fence proactively some vehicles. Not high volumes, so don't get too excited, but basically trying to, where we can, so things like pool vehicles and actually ring fencing, in the region of 50, 60 vehicles at any one point in time, just to try and reduce that actual vehicle lead time. With our tyre provider, we're also providing regular order bank statuses to try and proactively manage once vehicles are actually being delivered, be that this year, be that next year, actually they've got an idea of what kind of tyres that our customer demands may have in the future. We're also working with OEMs to try and improve the customer journey. Again, a recent example of that is working with Audi and actually introducing a digital customer journey for Audi EV vehicles. So that is yet to come. In terms of customer best practice, what we're finding is within the business, we're actually getting quite a lot of vehicle order cancellations, and that might be down to lead time, it might be down to other matters. But I suppose a little bit of a request from myself and on behalf of the business is where there is an order being cancelled, can that vehicle actually be housed elsewhere? Is there something else within your order bank or an order pending that order cancellation can go towards, rather than waiting and going to the back of the queue, placing a new vehicle order in the near future? Pool vehicles, as I've touched on, We can proactively manage where we can in terms of early sourcing of vehicles. Order status update, it might sound like an obvious one, but with vehicle lead times being as they are, we're encouraging our supply chain, where feasible, not to have those regular status updates on a weekly basis to say that a vehicle is on target. The realisation is the expectation that vehicles will actually be, at minimum 6 to 9 months before they come through. So just a little bit of a request again to ask that the information is shared, that vehicle orders are on track. The manufacturers and our supply chain are doing their best as they can to fulfil orders in the quickest possible time. So thank you, everyone, and I'm just going to now pass you over to Mike.
Yeah, thanks, Jeanette. So for those who don't know me, my name is Mike Anderson. I'm one of the senior managers who looks after both the car and van rental teams and the accident management teams. And similar to what Jeanette has just been talking you through, all of those market challenges that Jeanette's articulated are really impacting both the car and van rental supply chain and the accident management supply chain. And it really is almost a direct read across. If we look at the car and van rental sector in particular, I think all of the challenges that Jeanette's just been talking around, the supply of new vehicles and how much new vehicles costs have increased, that's really significantly impacting that car and van rental marketplace. Not least the fact that car and van rental operators have seen higher operational costs, but they are absolutely finding it a significant challenge to both secure a new fleet, but then also what they're finding is that the cost of that new fleet is significantly increased to what they've been used to in prior years. And absolutely, car and van rental operators have been used to doing, highly competitive bulk purchasing deals with OEMs in order to provide the vehicles that they put out to our customers on rent. Absolutely, what we're seeing in these current market conditions, which are extremely challenging, is that car and van rental operators really are at the back of the queue when it comes to any new vehicle supply. And that's had a really significant impact upon the available vehicles that they have to put out to our customers on a short-term basis. I think what we've also seen, which has made it equally challenging for car and van rental operators, is that because of all the challenges that both our customers, are having with deliveries of new vehicles, then any short-term hire vehicles that are out within the marketplace are generally staying out in the marketplace, and the turnover of fleet coming back in is actually significantly reduced. So we've seen some significant changes in customer behaviours, which again just all feeds into the availability challenges that both we're seeing as a provider of services and our suppliers are seeing in terms of servicing those needs. Knock-on impact of that, of course, is that what we are also seeing is that some of the fleet is not being churned in the same way that we would expect. So we're also seeing older and higher mileage vehicles out on rent to customers, and that in itself brings certain challenges around the need to service vehicles, which generally if a short-term hire vehicle is only with an operator for 3 to 4 months, that doesn't really come into effect, and we are seeing some of those challenges coming through. So certainly from a car and van rental space, we're seeing some really significant and difficult market conditions. I'll probably say that it is the most challenging market conditions that we've probably ever seen within the car and van rental space. So really tough. If I translate that to the accident management space, and I think there's very much a read-through from what Jeanette was talking around the service and maintenance networks within the accident repair networks, we are seeing some significant parts shortages through the disruption to sort of global parts supply chains, not least because of COVID, but obviously Ukraine and various other sort of factors. The same sort of challenges around skill shortages and wage inflation is really impacting our accident repairers, as well as seeing things like raw material costs that go into an accident repair increasing significantly. I think there's a statistic that the cost of paint is going up by something like 9 to 10%, in April. So, we are seeing some significant price rises right across the board. And I think when all of those things get factored in, what we're also seeing is that there is some significant pressure on the labour rates charges that our suppliers need in order to fulfil the requirements that we ask of them. At the same time, what we're also seeing is insurance companies really buying capacity within the marketplace and actually driving those labour rates higher to ensure that they are getting the capacity and the throughput of repairs to service customers. And clearly what that means is that if we are not looking to keep pace, then we fall down the priority queue. And that in itself can have a knock-on impact in terms of the lead times for booking vehicles in, which we're absolutely seeing right at this moment in time. It's not uncommon that where we've got a vehicle that is still drivable, that it can take up to 8 weeks just to get that vehicle into repair. So we're absolutely seeing stretched out lead times. And I think because of the wider sort of environment, the trading environment that we're seeing within this sector, and many accident repair centres traditionally being almost cottage industries, sort of very small businesses in the grand scheme of things, we are seeing increased business failure. And that, again, just has capacity challenges as, the available network that we've got access to is kind of being constrained. So it paints a picture of, I think, a really difficult marketplace with a number of challenges. But we're not standing still. We're trying our best to make sure that we are, trying to mitigate as many of those challenges that we've got. And actually, some of the activities that we're taking across both of those supply chains probably read through to both aspects. We are clearly communicating probably more often than we have done. There's been a number of communications that hopefully as customers you've seen. We're regularly communicating internally so that we're making sure that our customer-facing teams have all the information available, so that we can at least make sure that our customers are educated on some of the challenges that we've got. One of the key activities that we're looking to try to do is to add capacity to our network. That isn't always easy, but we've got some key initiatives that we're bringing on stream that are hopefully going to ease some of those challenges that we've got. But what I would say is there is no silver bullet. So there is no one supplier that we can bring on in the car and van rental space, for example, that's going to automatically fix some of the challenges that we've got. In order to try and address some of those concerns, though, we are reviewing the car and van rental proposition. We're looking at potential alternative modes of transport, such as taxi provision. One of the challenges we've seen in car and van rental in particular is, the ability to service 1- and 2-day bookings or airport bookings, for example. So we feel that a taxi solution might be something that can ease some of the pressure in that particular scenario. We're also taking some real action to try and improve the customer journey. Now, we're very aware that on the instances of us not being able to fulfill a requirement is actually, on the rise. So what we're very keen to do is to make sure that our customer journey and the communication that we have with our customers in those instances when we can't fulfill is the best it can possibly be. And I think we recognise that we've a little bit of work to do from that perspective. And we're also challenging some of our suppliers' behaviours. I think what we have seen potentially is some local behaviours at a branch level that are not necessarily in sync with the promises that some of our suppliers have made to us at a national level. So we're really tackling those behaviours to make sure that we are receiving, the priority that we need. So that's some of the things that we're doing from a car and van rental perspective. In terms of an accident management point of view, well, we are increasing our utilisation of non-genuine manufacturer parts and green parts, accessing, our vehicles that are total lost. So we're utilising our salvage partner to try and secure good quality green parts where appropriate. We're trying to use a wider use of both one-day repairs, smart repairs, to get a quicker turnaround of some of those repairs that suit that particular type of repair method. And what we will have to do is review our rates that we allow our repairers to charge. So that's really the labour rates, to make sure that we are in sync with the marketplace in order to maintain the priority that we expect as Lex Autolease. And traditionally we've been very quick payers for our supply chain, which has added a real benefit. But I think increasingly that's not enough to make sure that we are getting the priority within that supply chain that we need. So we are reviewing those rates to make sure that they're in sync with the marketplace. So that's the activity that we're taking. But we also think that there are some actions that our customers can take, and we're trying to push some of these initiatives and ideas out to customers to see if these can have a positive impact on some of the challenges that we've got today. One of the key things that our customers can do is communicate to their driver population and their stakeholders within their business on some of the challenges. And through the communication that we've done, we've hopefully given the ammunition to be able to do that. But I think the more people across our customers and their businesses understand some of the market challenges, I think the easier and better the experience perhaps will be. We are considering alternatives to 1 and 2 day hires, so I think we're asking customers to really challenge ourselves. Will a taxi, for example, be an appropriate alternative? It may not be, but again, challenge yourselves whether a hire car is the best approach. Try and pool requirements wherever possible so that one vehicle can cover multiple instances of use, and absolutely give as much notice as possible. And we've said a minimum of 3 days, but the reality is, 7 days is better because, the availability of vehicles, standing stock that our suppliers have available for short-term, immediate rental is so light on the ground that actually as much notice as possible will really help us to meet your needs. And the other thing that I would say for customers is if we cannot quite meet your needs and we make an offer of a different vehicle, or a different time, or maybe not a collection but a walk-in, I would absolutely encourage all of our customers to not decline that offer without truly considering whether that can meet your needs. And please also accept those offers as quickly as possible, because it is such a fluid marketplace at the moment that any delay to accepting an offer might mean that vehicle is rented somewhere else. So there are certainly some real challenges out there. So. And possibly the other thing I would say is consider if pool fleets, which we've moved away from in previous years, might be a short-term solution to achieve some of those short-term hire needs if we can't service that through our traditional marketplaces. So in terms of car and van rentals, that's what we would recommend. I think in terms of accident, I would always say that prevention is better than cure. So one of the things that we would always recommend to our customers is that they're reviewing their own internal safety policies, driver training policies, to make sure that safety agenda is front of mind across all of your driver populations. Because actually the best way to deal with some of the challenges we're seeing within the accident management marketplace is actually to not have that accident in the first place. So anything that can be done from that perspective will certainly have an impact. So thank you very much for your time. I hope that kind of just gives a sense of what we're doing across these marketplaces right now. And I'm now going to hand over back to Craig. So Craig, take that away. Thank you.
Thanks, Mike, and thank you to everyone, and thanks to everyone on the call for kind of sticking with us. We do have a couple of questions on the chat, which I'll cover off. But if there are any further questions, please kind of stick them on the chat. The first one from Catherine Dello at BOC. So I hope you're well, Catherine. I'm obviously spoken since pre-COVID days, but you said that recognising the constraints and challenges of the current marketplace, you have seen service levels drop from Lex significantly in the last 12 months. And what are we doing to proactively manage the third-party suppliers? So I won't repeat what Mike and Jeanette have just said regarding third-party suppliers. That said, probably what Mike probably didn't touch on is we're literally leaving no stone unturned in terms of challenging ourselves on whether the current model that we have is suitable for what is clearly a kind of changing environment, and we are kind of scanning the full market for how we kind of provide some of these services in the future. And just with regards to the kind of service levels in general, I'm not sure if you heard the kind of commentary just at the start of the call, but absolutely recognising the impact that particularly the vehicle supply chain disruption has had in terms of building an overall tsunami of recourts that has tied up our resource quite significantly. And we have managed to recruit, or in the process of recruiting, an additional 29 colleagues directly into the corporate business that will make a huge difference in terms of percentage-wise into the service areas. It's between 15 and 20%, so it's a significant commitment going in there. So the kind of view is, if you can bear with us as these colleagues come on trained and get up and running, then we expect service levels to return to a normal service level agreement within, certainly within the summer months. So hopefully that gives you some kind of reassurance around that. And, one other question, which is coming from our own Stuart Moore, actually, which is for either Thomas or Ashley, possibly Thomas, Tom from BVLA, I don't know if Tom's still on, but do government contacts acknowledge the transition to electric vehicles is still in its infancy, and that with us being at the front line, appreciate that this is the case, but could growing popularity of electric vehicles on new order books be suggesting to government tide has already significantly turned? So I guess the question is, the governments understand exactly where we are on that kind of journey, and the fact that we're right at the beginning.
Yeah. So yeah, Thomas has left, and I've asked Thomas to pull together a view from BVRLA, but albeit I think we're probably very much aligned. I think yes, they do recognise that transition is still in its infancy, but I think we also need to recognise that financially we can't expect them to kind of support EVs forever, and I think that's where we've seen obviously the changes to the plug-in car grants, and interestingly we then saw manufacturers reduce down prices to bring down the price of some of those vehicles. But yes, they definitely do, and I think I'd probably go back to Miriam's point. One of the things that I think we're very good at within the motor business of Lloyds Bank is engaging with all of the relevant government departments. So next week we've got a catch-up, and that's quite a chuck-away comment, but we've got a catch-up booked in the diary with the Transport Advisor to number 10. We've got a catch-up with the head of the Office of Zero Emission Vehicles. Miriam had a catch-up this morning with HMT around the used vehicle market. So yes, they are definitely aware, but again, there is an expectation that manufacturers need to do some stuff as well. So yeah, but I'll also share the BVRLA view on that, so it's not just my view or the view of the motor business.
Okay, thanks, Ashley. So that appears to be all the questions that we have. So from my perspective, opportunity just to thank all the panellists for their inputs. Thank you to all the attendees for kind of sticking with us. Hopefully got value out of that. Be keen that you give any feedback through your Lex contact. We would certainly like to be holding more of these types of sessions through the summer months, and at this stage have a couple more planned in June and September. So really keen to get kind of feedback, and we'll kind of try and shape future agendas to the feedback in terms of things that you'd like to hear about and talk about. So I'll stop the call there and wish everyone a good day. I hope it's a bit of sunshine where you are, and you've got an opportunity to enjoy some of that before the sun goes down. Okay, thanks again, and hopefully we'll speak soon. Thank you. Bye.
Thanks very much, everyone.
Ladies and gentlemen, that concludes today's conference call. We thank you for your participation. You may now disconnect.